The Luna Foundation Guard was behind this algorithmic stablecoin. They were buying up a lot of Bitcoin with the goal of making this a Bitcoin-backed stablecoin, trying to acquire 10 billion in Bitcoin. I think at one point, Do Kwon said he wanted to hold as much or be the second biggest holder behind Satoshi. And so when this all shook out, I believe they had in holdings more than $4 billion worth of Bitcoin. Lots of Bitcoiners, including Nick Carter, Preston Pysh, Corey Clipston, they were calling this project out a long time ago. They shared their skepticism of it, but others thought it was going to be a really innovative experiment that had a real shot. And I'm really sad to hear, postings on Twitter about people essentially losing their life savings. This project essentially suffered a bank run and hyperinflation. And now the supply of Luna, it exploded. It suffered what is essentially similar to what we saw in Weimar Republic. I mean, they went from, I think, a couple million Luna tokens to over 7 trillion. And the value went from over $100 last year per token down to fractions of a cent. So I know people lost a lot of money, and I really, really, really feel for them. But at the same time, this is an example that crypto is really probably the most capitalistic free markets industry that we have. There is no mama bear that's going to run in and save the day. There are no bailouts. Like this is what happens. Risk is rewarded, risk is punished. And so I think we're seeing that play out. But for those of you that are maybe unfamiliar, I had a hard time really understanding this algorithmic stablecoin, but I'll do my best. So UST was a Terra coin. It was supposed to be a stable coin, which means it's designed to retain a value of $1 at all times. Didn't depeg just a little, it crashed violently, very, very, very quickly. Other stable coins are reportedly backed by actual US dollars and reserves, although there are concerns about that. I know Caitlin Long is, I think, calling out Tether right now. But with Terra Luna stablecoin, the idea was to have this algorithm plus billions of Bitcoin reserves to maintain the peg. And in order to create Terra, you had to burn the Luna token. So when it was, say, $100 per Luna, you could trade 1 Luna for 100 UST or Terra. And this deflationary protocol was supposed to spur long-term growth. So the more people bought into UST, more Luna was burned. That would reduce the supply. That would make the remaining Luna supply more valuable. But then, as you probably heard from, the earlier guests, to entice traders and holders to burn Luna, creators offered an almost 20% yield on staking on something called the Anchor protocol. So the pitch is turn your money into UST. You can earn 20% interest. And so before this whole thing went down, about 70% of UST's total circulating supply was deposited in that Anchor protocol strategy. When the whole thing started over the weekend, I think there was more than $2 billion worth of Terra that was sold really quickly. It dropped the price down. It depegged Terra from the dollar. Then everyone piled in for this arbitrage opportunity. A massive sell-off initiated. You know the story now. Domino, domino, domino.